Welcome back to the E-commerce Impact Podcast. Welcome along, Jarrod Souza. Today we're going to be talking about financial planning and financial management for ecom businesses. And actually it's something that I feel I have a bit of a gap in my own knowledge, so I'm excited to pick your awesome brain on this topic. Why don't we start off by, if you would like to introduce yourself to the audience, tell us a little bit about what you and your business do, and then we can dig into the topic.
Yeah, so again, my name's Jarrod Souza. I'm the founder of CFO Expertise, but we are actually rebranding to D2C Wealth, which you can see on my shirt if you're watching on video. And I've been in ecom D2C for over 10 years from the financial aspect. But I'm probably one of few CFOs that actually hates accounting. So I've got accountants on my team, but I love the data analytics. And so what we're really good at is tying like marketing non-financial data to financial performance. And so linking those two together, because in D2C brands, like marketing and finance are so closely tied together that you just kind of need to know how they interact with each other. Yeah.
That is such a good point, because I think one of the problems I see with the smaller startup ecom brands that I mentor is often they'll have an accountant. Maybe it's an accountant that someone in their family recommended, or someone that that they've worked with in another business, and they'll say things like, my accountant says we need to cut costs, so we're not going to spend on marketing. And that accountant clearly doesn't understand the direct relationship between performance marketing spend and revenue. They're just not realizing. They see it as more like an investment in brand, or like, someone's doing an ad on the radio. They don't realize that, there's a return on that ad spend that's very direct. So that's always a bit of a battle for me, working with accountants that don't have a kind of D2C ecom understanding.
Yeah. I actually have a funny story about that. So one of my clients now wasn't a client at the time. He was dealing with a different fractional kind of CFO. And once I onboarded him, went through his stuff and looked at his customer lifetime value, what he was spending to acquire customers, and was like, man, you should actually be spending more to acquire customers, because his customer lifetime value was so high that he was like leaving future money on the table. And I'll never forget this. He just said, he goes, I knew I was winning, but the other fractional CFO just kept telling me to cut expenditures and cut overhead. But like in my gut, I knew we were doing the right thing. And it's like, I was able to come alongside of him and show him with data that what his instincts were telling him were actually correct.
Yeah, that's amazing. Yeah, it's we'll get into this question as it is my next big question to you. But like, one of the things I say to people is like, your ecom business won't scale if the customer acquisition cost goal that you have is actually too low. Like if you are saying, I need to acquire a customer for $20, and you're sticking to that and you're holding to that, and actually your business could afford 30, you are holding yourself back from being able to scale. And that's a real light bulb moment for people sometimes, to realize that by being too conservative, they were actually like stopping their business growth. So understanding, what was that?
Yeah, who's the marketing guru that said whoever can spend the most to acquire a customer wins?
I can't remember who that was, but yeah, I've definitely heard that as well. Yeah. Exactly. So working out and getting this right, because if you get it wrong, you're going to go into like negative profit. But if you get it wrong as well, you're going to just be stagnant and not grow. So it's one of the big reasons I think people stay stagnant, is they just don't realize that their marketing KPIs are holding them back. Cool. Well, let's dive in.
Yeah, sorry. The when people stay stagnant too, it's like they're assuming that everything is going to keep going at status quo, which you very well know, like Facebook or Meta algorithm changes or different things happen. And so you kind of always have to be on the offensive in that regard in business.
Exactly. You want to be more aggressive than the competition. You want to be spending more than them, able to spend more than them to get the traffic to your site, so that you can beat them in the auction. Because it's a competitive ad auction that people don't necessarily realize.
Right.
Yeah. Cool. So our first question today is, how do you figure out that customer acquisition goal? So cost goal. So CAC, as it's referred to, for those who don't know in the industry, it's like what we're talking about, the amount we're spending on marketing divided by the number of new customers that we have gotten in a given time period is referred to as the CAC. So how do we work out what our CAC should be? So I've got a little example here. a CAC of 50 might give me a $5 contribution margin on average, whereas a CAC of 60 might give me a $15 contribution margin on average. So contribution margin being profit after, it's sort of, it's a proxy for profit. It's what you've got left after all your variable costs have been covered. If I got that right?
Yeah. So I would
Yeah.
say, so it's your the average order value, customer lifetime value minus your cost of goods, your shipping, and your merchant fees. So I kind of stopped there because then the remainder of that spend would be like your CAC or kind of margin that you have to
Yeah.
supply our
Okay.
customers.
Yeah.
Yep.
So how do we actually pick between those two examples, for instance? Why would I choose, a CAC of 60, which gives me a $15 contribution margin, or a CAC of 50 that gives me $5? Like, how do I know how much I should be leaving on the table in terms of profit in the first place? Like, how do I figure that out?
Yeah. Man, like what's funny is this is such a loaded question because there's so much more data that could go into it. But I'll start, and if you're like, okay, you're way off in left field, like let's come back to the actual question. But I would say it depends, and I hate answering that, but I'll go through some. So it just depends on one, how many number of customers you're acquiring, right,
Mm-hmm.
at that amount, and then two, what's the customer lifetime value from those cohorts, right? So like if you're breaking this down and you're looking at these numbers and saying, okay, spending $60 though to make 15 compared to $50 to make 5, but depending on the product that they're purchasing, like this group of customers might be worth more in 3 months and 4 months and 5 months, right? And so
Yeah.
we just got to we can't just put things into one silo. We got to look at the overall business and what's happening.
Yeah.
But what I would say is like you bring those together, your contribution margin, customer lifetime value, and your CAC, and that's where you can really figure out how aggressive you can get. But where I always kind of start is like, first of all, what's your break even CAC that you can go to? Like what's the threshold where you're breaking even to acquire the customer? You still have to cover your overhead in the business, but like, okay, if you need to be profitable on the first order, then let's just like, if your break even to say is 50, then let's start off at $40 and see how many customers we acquire and be testing from there.
And like you say, if you need to be profitable on the first order, so that would be a situation where the brand or the founder is bootstrapping. They don't have like a big pile of cash they can use to like lose money on that first customer. They need to make sure that what it costs them to acquire the customer is covered by what that customer is spending. So
Right.
what
That or they don't
about,
have anything else to sell them. Do they just have one product, right? And then
yeah,
it takes 6 months for their clients to use that product.
right. So that's the other example, isn't it? So if it's a
Yep.
one and done type of a product, something where there's not a lot of repeat purchase or there's not other products to buy. So example of that would be we had a brand that sold baby mats, and they were big, quite, investment piece, large baby mats, fairly expensive, like $200-ish. It's unlikely someone's going to buy two. So we had to make sure we're more than profitable on that first order, because the first order is the most likely going to be the only order.
Nice.
Whereas skincare, food and drink tends to be low average order value, but the whole point of that business model is people will keep buying their skincare every 3 months. They might then also try the mascara, or they might also try the hair care. And what you're doing is buying a customer who you then kind of like, you get a lot of revenue from in the future.
Right. Yeah, anything consumable, right? Like as long as you create a good product, yeah, you'll get
Yeah.
repeat purchases.
And you talk about lifetime value. How do you go about calculating that?
Yeah, so there's a lot of software that does it. I like to see the data, and so I actually pull directly from Shopify and use the email address as a unique identifier. And from that, I break it down by their first order, what they're worth after 30 days, 60, 90, 120, 365. And then I go out year 2, year 3, and then lifetime. And so if you're, really like some of these bigger brands can go out like, it's pretty amazing, like 18 months before they break even. Like, but so I always advise, like, if you get aggressive, you want to make sure you're staying within that year mark just to be safe, right? Because you want to make sure you understand your data. But if you can calculate your CAC and your customer lifetime value, you can quickly see like, okay, am I out of range here on what I'm spending currently to acquire a customer? Like,
Yeah.
or it's not even profitable for me at any point.
Yeah.
Yep.
And how many years would it take until we can rely on that data? Because a lot of D2C brands are new, the space is evolving fast. Like, how much data do we need to be able to actually accurately project a 1 or 2 year lifetime value?
That's a good question. Yeah. Because, yeah, so I monitor it on a monthly basis because I want to make sure each month is behaving like, but as long as we have a year, you can create ranges where like you have a baseline and a stretch, right? So I like to create ranges too where it should be somewhere in here. So if it hits a low range, are we still good? Yeah.
Hmm.
But
Yeah.
yeah, at least a year. I mean, if you're a new startup, like you got to just put some numbers down. And so, once you start seeing some sales, then you can start like creating a forecast based on that. But lifetime value is hard to project if you don't already have historical data.
Yeah.
Yeah.
And so there's software. I mean, I know a couple of software packages that do this. So Suite Analytics is one I've looked at. Lifetimely is another one that does it. So they're basically plugging historical data from your Shopify store and then using that, looking for the pattern from the past to like project what's going to be like anyone new you've acquired, how much they're likely to be worth to you.
Yep.
Is that kind of a good starting approach for brands that maybe don't have you yet on board?
Yeah, it's good just to know. And their Lifetimely, is it free? No, it's a little bit of a charge, right? Like,
I think there might be a freemium. There might
yeah.
be a kind of early option. Yeah.
Yeah, it's good. But then there's a report on the back end of Shopify, your cohort analysis that'll kind of break that down for you as well. But it's just giving you historical data. So if Lifetimely can, yeah, make that projection, it's a good place to start. There's also a new company kind of up and coming in that space called Wild with an E, WILDE. It's Clint
Yeah.
Dunn is the founder. That's actually using AI to forecast, and he's doing some pretty cool stuff with it.
That's awesome.
Yeah.
And so, is there like an industry standard, like rule of thumb for lifetime value to CAC ratio that like makes sense and is like a solid kind of thing to aim for?
Yeah. Yeah, that's interesting. It depends on their margins in their business too, right? Which is what like we always start with the financials. We make sure there's a strong financial foundation so we truly understand the margins and their expenditures and their gross
Mm-hmm.
margin, how much it costs for their inventory. And then we can break it down from there because every company is different, in terms of the manufacturers they're dealing with and shipping costs and all of that. So CAC to CLV, if you can get a 3-to-1, like that should be in good
Yeah.
health,
Okay.
right? And again, depending on your overhead and all of that, if you can
Yeah.
stay there.
And the customer lifetime value, we're defining that as the total revenue, not the profit, like not the contribution margin or profit from them.
For that 3-to-1, it's just that total customer lifetime value. But I
Yeah.
actually have a customer lifetime value contribution margin chart where like once it breaks the CAC bar chart, like you've broken even on that cohort. So because I have clients that are doing a lot that are actually going negative for 3 to 4 months
Wow.
in
Yeah.
terms of investing in their customer acquisition. So they're not breaking even, say they acquired customers in January. We still maybe just broke even now. We're in
Yeah.
May. Mm-hmm.
And building a business in that way, therefore, by definition, they must have outside money that's funding it. They couldn't be bootstrapping and having a 3 to 4 month like profitability.
Well, well, they bootstrapped it at the start, but they're just mature now, right?
Right.
So
They have enough cash flow in the business to
yeah,
fund that and to be
yeah,
more aggressive because they've built up. Okay,
that's
I
right.
see.
So
Yeah.
what happens, especially with this client, is they had such a strong customer lifetime value. So we are acquiring, and I'll use numbers because I'm not going to say who the client was, but we are acquiring their customers at about $60, and we were acquiring about 5,000, 6,000 per month. But the customer lifetime value was so big that we started to get more aggressive. And so now our CAC is like at 95. So from 60 to 95, but we're acquiring about 10,000 new clients per month, but we are going negative now. But what's happening is we're getting like, as these clients start going each month, we're getting much more returning customer revenue. So
Mm-hmm.
then that's much more profitable. And now we can still continue to get more aggressive. So we kind of stepped into it where it's like, okay, we'll go negative for 2 months. Now
Yeah.
we still have more returning customer revenue. Let's go 3 months, and you can kind of slowly step up and get more aggressive. So because like you said, as you're scaling, you have to order more inventory. So you got to watch your cash flow from those different perspectives and customer acquisition and the inventory that you need to order.
Yeah. Yeah. So actually, that brings me to my next question, which is cash flow forecasting. So if they're achieving a profitable CAC, like we've said, like we've worked out what it should be, how do we go about figuring out how much stock to order and not go into negative? Because this is probably where most ecom businesses fail, right? They just don't figure this out properly.
Yeah.
They order too much stock, or they don't order enough stock and end up, having stock outs, and that, disappoints the customers.
Right.
So how do you balance these two, and how do you help your clients figure that out?
Yeah. So what we always start with is looking at historical data, and if there's seasonality or any drops, right? Which we all know there's seasonality in November. Typically you're going to have this spike. And so, but creating a forecast to know like how much inventory you're going to need based on this forecast. And then just each month, am I hitting that or not? Then you look at your lead time. How far do I need to be ahead of it? When are my deposits going to come out, right? And so, yeah, we have a cash flow forecast that we built out specifically kind of for this, that we just try to simplify it enough so like people can at least get a framework of where their cash position is going to be. But it's first just getting it down into an Excel sheet or Google Sheets, just so you can like see it and fully understand it. And then you can go back to your manufacturers and start negotiating on the deposit, or, can they extend terms to you, right? It's all about, can I push off the money going out of my business as long as possible?
Yeah. Yeah. I think you shared a story on LinkedIn the other day of how you like jumped on a plane to China once to like renegotiate the cost.
Yeah, that was actually one of my first CFO roles at an ecom brand. We were in the golf space. We scaled from 4 million to 43 million in about 4 years. But as I was there, I noticed we were going through an American agent and realized if we dealt directly with manufacturers, we could save 50% on our cost of goods, which was a significant amount of money. So
Wow.
The founder was like, in 2 weeks, I was on a plane and on my way to China. And it was fun. Yeah.
And there was like millions saved from you jumping on that plane. Yeah.
For sure. And you just talk to your manufacturer, like if you're starting to scale, like, can you get a discount on quantities? Can you, right? Like not everything's set in place. And so I think sometimes people are afraid to talk to the manufacturers. Another point of risk is only having one manufacturer. You want to make sure you spread that out as well, and just try and get that per unit cost down any way that you can while still having a quality product. I always say that.
Yeah. So yeah, I'm hearing there's kind of a few themes here. Like a successful e-commerce business will be able to negotiate to get their costs down. They'll be really good at retention and really understand like how much a customer is worth to them in the long run, and also be working on all fronts in terms of their marketing to make that customer worth even more in the first purchase, but also in the lifetime. So that comes in with email marketing primarily, and social media, and what you're doing kind of to like keep the customer, and then really understanding what you can afford to pay to acquire a customer, and getting that actually as high as possible, which seems counterintuitive, so that you can be as aggressive as possible with the scaling. So yeah, that's really interesting.
And again, it just depends on what's the vision the founder has for their company. There's different strategies to deploy. So it always comes back to that. Like not everybody wants to scale and have a huge exit. I mean, most do, but not everybody.
Yeah, it's interesting. I surveyed my mentees in my coaching program, and I think 90% of them were like, yeah, scale and exit. Which, but yeah, I think sometimes
every time I ask a founder that question, it's always like, well, I want to exit in 3 to 5 years. It's that same like time frame.
Yeah. It's interesting. Yeah. I mean, there's pros and cons to both, right? I can see, having a really successful, profitable ecom business that runs itself, maybe you don't need to sell it if it works really well. But I guess it's that decision about whether to go for aggressive scale or go for a maintenance type business.
Right.
Yeah.
And like we kind of said at the beginning, you just can't become stagnant in this industry, right? Otherwise you're going to be falling behind. So
yeah, it's almost impossible to build a business, I think, that just sits still, like, because you've always got to be pushing the next thing. I mean, marketing changes every 5 minutes, so you can't just have that on automatic, unfortunately.
Yeah. There was something that came to mind too about supply chain, which was in those negotiations. Another thing is what I've seen work pretty well is buying more in bulk, but only shipping what you need, right? And a lot of factories will do this if you've got a good relationship with them. So it'll get your per unit cost down, but you're not having to take that all at once. Like you might order every kind of 2 months you paid the deposit down, so you've already got it there, and then it lowers your lead time as well and kind of help with cash flow as well.
Interesting. Yeah. And is that because the storage costs in the country of origin are theoretically cheaper than the country that you're selling from? That
Well,
kind
for
of where
sure,
the
for
saving?
sure. Like, I mean, I'm dealing more in U.S. companies, right? So 3PLs and their storage fees here, but along those lines too is manufacturers. Like, if they have economies of scale as well. So if they can create bulk, it's cheaper for them. So they would rather do that and just hold it for you,
Mm.
and then make sure that you're happy as well.
Yeah. That's
So
really
it seems to
fascinating.
work well. Yep.
What are some of the biggest mistakes you see people make in this area? Like, when you go into a business, what are these kind of like typical problems you see and you solve often?
Yeah. So one of the biggest ones is founders are not looking at their financials on a regular basis. And then two is whoever are doing their financials, we probably 85% of the people we've onboarded, their cost of goods were calculated incorrectly. So they don't truly understand their gross margin. They might be on cash basis instead of accrual. So one thing to look out for, if you look at your financial statements, look at your gross profit, divide that into your net income, that gets you your gross margin. But if it fluctuates by more than 10% over month, then that means it's probably not calculated correctly. It
Right.
shouldn't have that big of a fluctuation, right? So that's just a quick, snapshot. And if it's not, then it's hard to trust your profitability. And if you can't trust your financials, then you're like, I don't know what to use as a source of truth to make decisions from.
Yeah. So you went quite quickly through a couple of things there. Can you give us some definitions? So you said divide your gross profit by your net something,
Yeah, by your net revenue.
net revenue. Yeah.
Yeah, yeah. And that'll give you your gross margin. So you've got your net revenue minus your cost of goods, and that's your gross profit. So it's
Yeah.
just going to be that percentage. Yep.
And net
So
revenue is total revenue minus tax.
minus returns, refunds, discounts. Yeah.
Right. And
Mhm.
what about sales tax? Is that it's minus that as well?
No, typically we don't count sales tax as income because it's just a pass
Right.
through. Should be a pass
Right.
through. So
Yeah.
most of that should just live on your balance sheet, and you build up this account and then you pay it out. Yep.
Yeah. How does Shopify look at that? So if people were trying to pull their net revenue from Shopify, would it take the tax out automatically?
Yeah, when you pull the sales over time report, like you can look at the net sales. I think it's in
Yeah.
the middle. After that is tax and shipping. But a lot of times we'll pull shipping back in, but we just want to make sure to, it depends on how profitable you are, but you want to compare that shipping to what you're being charged and seeing if you're losing money on.
On your shipping. Yeah, that's a good point. But yeah, because I think a problem that a lot of people get into is like Facebook Ads Manager is probably telling you the revenue, including the tax. And in some
Mhm.
countries, it's 20% sales tax. So that's a big delta you have to then cover in terms of to still have something left over after you've paid for the ads and the product.
That's right. And that's where we always start. Like, so we start on the financial aspect and then work our way into marketing and data analytics. Because for us, we've reconciled all the bank accounts, all the expenditures. Like, this is the source of truth, right?
Mhm.
A lot of times when you're trying to do it like just on a Google sheet or back of the napkin, like there's just expenditures that you didn't know came through or you weren't aware of. But like we've completely reconciled every single charge. And so everything is there. And that's kind of our source of truth. And then that's where we build out the strategy and foundations and metrics from that.
Yeah.
Yeah.
Yeah. That sounds like something that founders probably really can't be bothered to do, but they need to do, and maybe just don't even know how.
Yeah.
So, what do you have? I hear in our industry a lot of people talking about like what is a good contribution margin or what is a good gross profit margin to have for an ecom business. And I've heard some people say as high as like, oh, it needs to be 75% to be scalable, to be profitable. And of course, it depends on like lifetime value as well, of course, and like overall like ticket price too, whether it's high ticket or low ticket. But do you kind of have at least a benchmark or a kind of KPI North Star that you're telling business owners that, their product cost should be this proportion of the overall ticket price?
Yeah. Yeah. So some kind of back of the napkin is like you want your gross margin 80% or better, right? So 20% cost of goods
Yeah.
is a good kind of threshold. And then I kind of work my way down. So like now in selling expenditures, so shipping, so your freight should and I'm talking US companies, I know it's different like in Canada, but should be 10 to 12%. So that range.
Yeah.
Merchant fees, 3%, right? Just
Yeah.
there. So then
Don't
ad
change
spend,
it.
you can spend, 30 to 40% in kind of your ad spend and your customer acquisition. And then kind of below that, you want your G&A, like all of your overhead, like kind of like 20% or lower.
Right.
So that gives you, anywhere from 10% profitability up to like 17%. So most of the time we're seeing about 10% in D2C brands, except for those that are like really scaling and their fixed expenditures have become such a small percentage of their overall business. They've just stayed really lean. Then their margins are anywhere in the
Yeah.
20% range. Yeah.
Right. So you are saying then that like a good healthy ecom business that would be have potential to have an exit would be somewhere between 10 and 20% profit margin at the end of the day after everything is totaled and salaries are paid and overheads are covered and cost of goods. Yeah.
Again, I would say it depends, because if the strategy is going to market, then what we would do is pull back a little bit on the customer acquisition, rely more on that more profitable revenue from returning customers, and increase that profit margin so you get a higher multiple.
Yeah.
So, right,
Yeah.
it's like, it just kind of depends on the strategy and the moving parts and the
Yeah,
levers
of
that we can pull.
course. But it's good to know like an industry benchmark because, going into a business like this, I think sometimes ecom founders like think that they're going to be, that if they're doing $1 million in revenue, that's going to be a good income, but actually that's actually not
Right.
that much. Yeah, after after everything else is paid for. And so you said 20, so cost of goods sold, 20% of the ticket price. So $100 product should cost 20 to manufacture
Right.
to get to that number in the end.
Yep. That's right.
Yeah.
And most of the e-com and D2C brands are around the 10% profitability that we deal with, but like we have some apparel brands that are in the 20% range, which is really interesting because they don't have as high of a customer lifetime value. It's just not as strong as like a supplement or a consumable brand, but they just operate really efficiently. Yeah. So most of them are around the 10% range, but there are those outliers that just are crushing it because they just stay really lean.
Yeah. And in an early stage of an ecom business, they might have higher product costs, but as they scale, there's economies of scale, better negotiation, leverage, and all of that. So if someone's coming to us saying for $100 product, it's costing them $50 to manufacture them, that's not necessarily like a broken business from the start. I guess it's a sign that they need to definitely get cheaper at making their product, though, right?
That's exactly right. And I would always go back to the manufacturer and say, at what quantity will I get a price break? Right. So you kind of know on your radar, like, okay, in the forecast at this point, that's when my cost of goods is going to start going down. Yep.
Really interesting.
Yeah. Yeah. If you've got a good, like getting supply chain right, which is the ordering, the cash flow, the timing, like can be such a competitive advantage if you get it right. It is hard to get right if you don't really know what you're doing, but yeah, that can literally bankrupt a company if you have too much inventory that you've expelled your cash and it's just sitting there and you're not able to move it.
Yeah. Yeah, definitely. Switching tack, what is your kind of favorite success story that you've had where you've gone into an ecom business that was maybe struggling to grow or struggling to be profitable and you've been able to turn it around, and why and how?
I don't know. My personality is like, I just show the data. I don't pull the levers. Those are all the marketing people, right? But we work well with agencies. There's a few. I would say the one where I was the CFO at the golf company, it was just an amazing ride to scale that like we did in 4 years. I have another brand that's in the kind of health and beauty space, and we came on board. They were already doing 8 million. So they were doing 8 million that year, but they were still on cash basis accounting. So it's like 1 month they were so profitable, and then the next month they lost a ton of money because they were just writing off all their inventory. And I asked the founder, I'm like, how did you guys even get to 8 million? Like there's no way you're using your financials to make any sort of decisions. And I think it was just ignorance, not knowing how close they were to like bankruptcy. And as long as there was cash in the bank, they kept pushing. But they spent a lot on PR as well, which again, I'm coming in, I'm saying there's no attribution for that, but I always kind of just figure out the lay of the land of companies before I make any recommendations. So I came on board, got all their financials corrected, started showing profitability. They were profitable. And the way that they were using PR was creating that halo effect to actually drive down their cost of customer acquisition on Meta and different, like they used it brilliantly. And the next year they went from 8 to 25 million. And this year we're projected to do 50 million.
Wow.
All profitable.
That's amazing.
Yeah.
And that's where, some accountants might have gone in and gone, cut the PR.
Right. Right. But until you have context and truly understand like how everything works together, like I will never make a suggestion until I have a full understanding of the business and the vision of the founder.
Yeah.
So they're an amazing story.
Yeah. It must feel really good to be able to go in there and like, it's almost like putting a pair of like someone who's like been operating blind and you're putting on like a brand new pair of perfectly matched glasses and they can finally see how their business works.
And entrepreneurs intuitively have great gut instincts, right? And I think that's how they got to 8 million. But then when you come and I can put data behind that for them, they become like superheroes. Like, because now that they have more confidence to make these decisions, what they were kind of already feeling anyway.
Yeah.
Just gives a vote of confidence for sure.
Yeah, definitely.
Yeah.
Awesome. Yeah. Well, is there anything else you want to share, or if you could tell us where we can follow you? I think you also said you had something to share with the audience that can help them kind of figure out a lot of this stuff on their own.
Yeah. So if you go to D2C Wealth and it's just all letters, I think I own each other acronym, like D and the number 2, but anyway, D2C Wealth, direct-to-consumer-wealth.com. And there's a cash flow calculator there as well for everybody. If you just go into resources or if you go to D2CWealth.com. So it's just a template for you to enter information and forecast through time. And, it'll ask like lead time of inventory and like at what point should that cash be coming out? And so again, I always treat it as a framework. It's not gospel. Treat it as a framework, right? To at least give you like guidance, right? In the map of where you're going.
Yeah.
And then we also have a CAC break-even calculator, which I think you've shared before, which is just like, I don't even know where to start, what, CAC number to give my agency. This will give you the threshold of, where your break-even is. And if you need margin on that first order, then just lower it from there.
Yeah. I'll make sure I share those in the show notes. And what about whereabouts do you hang out on social? Where can we find you?
Yeah, I'm mostly just on LinkedIn now. I think I've given up on the other platforms. So yeah, it's just Jarrod Souza. Yeah, it's my name on LinkedIn. Yeah, that's where I'm mostly hanging out these days.
Awesome. Yeah. Great. Well, I'll see you there.
Yeah.
Thanks. And thanks for coming along.
Yeah, thank you. This was great.